So finally, we're done with Modigliani-Miller theories. Do you think it's the only theory? No, we will talk about 2 more theories, but we're going to spend less time on them. One is pecking order theory. The other one is market timing theory. In the pecking order theory, was introduced by Myers and Mejdov in 1984. And you weren't even born yet, right? In 1984. Okay. Me neither. Me neither. Okay. Niye gülüyorsunuz? Oops. Okay. So pecking order theory is all about asymmetric information. So CEOs know more about their companies compared to investors. We know that what kind of reaction stock price will reflect when CEOs make announcements. CEOs can time their announcements as well. And we know insiders have more information about the company because insider trading provides a lot of gain to the insiders. So it's not something very strange to say that insider CEOs know more about the company than regular investors. So this asymmetric information will turn into a capital structure theory, actually. And Myers and Mejdov says it's almost like your capital should be M&M to produce a capital structure theory, so I don't have a chance, right? It was Modigliani-Miller, now it's Myers and Mejdov, so M&Ms will be confusing. So in the pecking order, there's an order of using capital structure. So Myers and Mejdov says firms first use internal funds, then they use debt, then they issue equity. Is it consistent with real-life evidence? Do you remember anything I showed you before? Like this? Do you remember this? Yes. So most of the companies use internal funds anyway. Then they use debt. And actually, equity issuance is even interesting because this shows that there's more repurchase of equity than issuing equity. So it's almost like companies use debt for repurchase activities. Okay, so this is pecking order. Kind of looks like it's realistic. How does it change? How is it different from M&M theory? In this case, we don't have any target debt-to-equity ratio. Remember, in M&M, we have an optimal debt-to-equity ratio point. Remember that? It was like 50 minutes ago. So there was a target debt-to-equity ratio. Here, use internal funds. Oh, it's not enough? Use that. Oh, it's not enough? Use equity. So there's no target debt-to-equity ratio. And for pecking order theory, it says profitable firms use less debt because when you have lots of profits, you're going to have lots of internal funds. But M&M says what? According to M&M, if a company is profitable, what happens? They can take on more debt because they have high level of cash flows. There's less bankruptcy costs, so they use more debt. And pecking order theory says companies like financial flexibility. For Modigliani-Miller, we didn't even talk about financial flexibility. Okay, it was all about where we are in the graph. We are trying to increase the value of the firm as much as possible. So how does this arise? Basically, everything they say is it is common sense. First, it says we know internal funds are the dominant funds in the economy, and we saw the graph related to it. And internal funds are there. Like CEOs don't have to go to the banks. They don't have to issue equity. There's no cost of using internal funds, right? There is cost of debt, cost of equity. Nothing about internal funds. There is no transaction costs. And the easiest thing is there is no one asking you questions if you use internal funds. Think about yourself. If you're using your parents' money, then they have some rights on you about how to spend your money. But if you can make your own money, then you can say, this is my money, so you cannot say anything to me. Of course, don't say this to your parents, okay? They take care of you all the time. Just be a nice son or daughter, okay? But you got the idea. So in general, according to the pecking order theorists, they say using internal funds is awesome. And this is what we see in real life as well. Another thing is about asymmetric information and how it's going to affect firm behavior. Remember, pecking order says use internal funds, then debt, then equity. Now I'm going to show you why using equity might be a bad thing. So there are two companies, Hawkeye and Cyclone. I went to University of Iowa. Our football team's name, when I say football, American football, of course, it was Hawkeyes. So that name comes from it. Suppose that those are two identical firms, and all the public information, all the market expectations are same. Their stocks currently trade at $100, okay? One CFO knows that the value of the firm is actually $80. The other CEO knows the firm's actual value is $120. So both of the firms need money, and they can use debt or equity. So now you get the picture, right? One is undervalued, one is overvalued because of the asymmetric information. CEOs know that. So suppose that Hawkeye is beginning a 1 million public debt offering. So it's using debt. Cyclone is planning to issue 1 million equity at $100 per share. So basically, the amount of capital they raise is identical for both firms. So question to you. Which one you think, you're investors, you're not the CEO, you don't know which one is which, but as expectation, which company is actually worth $80 per share? Is it Hawkeye's or Cyclone's? So Cyclone is issuing equity, Hawkeye is issuing debt. One firm is undervalued, one firm is overvalued. So if a company is issuing equity means selling equity to shareholders. So as CEOs, would you sell equity if you think your firm is overvalued or undervalued? In which, okay, yes. So overvalued CEO, overvalued firm CEO should issue equity. So looking at this information, you're going to say that, okay, Cyclone is actually overvalued, right? So how do you think markets will react to this action? What's going to happen to stock price? It will decrease because it's overvalued. Exactly. So in that case, do you think any company would consider issuing equity? Because every time they issue equity, it's going to be a bad signal for the investor. They will say, oh, it's overvalued. We should be away from it, right? So what do the CFOs do? Actually, they will both issue debt, because when they issue debt, there will be no market reaction. Actually, there might be favorable market reaction, and in real world, this is what we see. So do you see pecking order? So use internal funds. If it's not enough, be away from equity. Just use debt first, because equity issuance will signal something bad, or not, yeah, signal overvaluation. Okay. So basically, for any firm, it will be suboptimal to issue equity. Why? It's big. There are two cases. Either your equity is underpriced, and if it is the case, as always, debt is cheaper, so use debt, or your equity is overpriced, and when it's the case, you issue equity, it's going to signal overvaluation. It will lead to mispricing, or it will report mispricing, let's say. So stock price will decrease. So according to the pecking order, we should see more debt, less equity. Let's see whether it's the case. Okay, this is the first 6 months of which year? Okay, okay. From 2001 to 2006, you can see how much companies issued bonds in light blue and how much they issue stocks in darker blue. So do you think pecking order works? Companies use more debt compared to equity. Another thing is something similar. This is from Burke and DeMarzo, another book I recommended. So as you can see, from 1975 to 2008, capital expenditure of companies increases. Capital expenditure is what? Give me an example of capital expenditure. You buy a factory. You buy land, okay? So as it increased, let's see how companies reacted to that. That is in red, if you can see it. So in the crisis times, of course, that usage decreases. But if you look at the final years, you see that ratios are increasing. So, and if you compare debt to equity, debt usage is always higher than equity. And you can see the difference in black. So as you can see, almost always net issuance, debt minus equity is positive. So companies use debt first and then equity. The last thing here, or last two things I'm going to show is how market reacts to leverage increases or equity increases. So this is from a JFE paper in 1994 paper. He looks at exchange offers, and in the exchange offers they changed debt to equity ratios. So this guy showed that if the offer is increasing leverage, so this is the announcement of the exchange offer, market reacts favorably to leverage. Why do you think it's the case? So when there's a leverage increasing offer, exchange offer, stock price increases. Why do you think it's the case?
Because if a company is issuing new debt, it means their stocks are undervalued.
Or fairly valued, or overvalued. But it doesn't say anything about the valuation that much, but it says a lot about how the CEO expects the company to do. So if a CEO thinks that, and I'm talking about an ideal CEO, if a CEO thinks that the company will be in trouble in the future, do you think the CEO will increase leverage now? No. So leverage increasing action should be taken by a CEO if the CEO thinks there is positive prospects in the company. So it's a good signal for us. For leverage decreasing offers, we don't see anything actually. There's a decrease in stock price anyway, so we kind of see a decrease in stock price. It's not probably that significant. But overall, we can say when there's a leverage increasing announcement, it's good. It's taken as a good signal by companies. And when there's an equity issuance, this is what we see. So at day 0, we have an equity issuance. So as you can see, 1 year before the equity issuance to time 0, we see an increase in stock price, increase in return. But at the announcement, we see a decrease in stock price. So when there's an equity issuance announcement, market reacts unfavorably to that. Why do you think stock price increases before equity issuance? Or is it egg and chicken thing? Yes?
I'm kind of like making this up, but does it have something to do with the value of the company? As in when the announcement is made, then people start thinking like, oh, the company is like losing something from its value. So like it's like share prices should be decreasing as well because like, you know what I mean? Like assets are like decreasing, something like that.
Okay, what I understand might be different than from what you're saying, but what I understand is that if you're a CEO, when are you going to issue the equity? I mean, you can issue the equity when stock prices are low, or you can issue the equity when stock prices are high. And in both cases, it's going to signal overvaluation. So in both cases, stock price will decrease. But which one is better for you to issue equity? I mean, you're going to sell stock. So you're going to sell the stock when stock price is high. This is probably happening, like the stock price is increasing, and it comes to a point that the value of the company is higher than the fair value, and it seems like timing. So you do the equity issuance when stock price is really high. So it might be just a statistical thing, right? Because you wouldn't issue equity when stock price is already low. Like you're getting a punch from low stock prices, another punch because of the effect from the investors, the response from investors, right? It's going to be a bad sale, and the stock price will decrease even further. So probably that's why. I mean, as I said, chicken egg. Probably 1 year before stock issuance, they weren't planning the stock issuance, but when the stock price got really high, then they issued equity. Okay. Okay. So for pecking order, again, we're using internal funds. If it's not enough, we issue debt. If the company cannot borrow any more money, then the company should issue equity. So a more explanatory way of looking at pecking order is that I'm just repeating the same thing, but I'm going to introduce dividends here. So firms will prefer internal financing. Then firms actually will have very sticky dividend payout policy. They will have stable dividend payments. And they will not want to change dividends that much. And in the next week, we're going to talk about payout policies as well. And you're going to see why it's the case. And because of the sticky dividend policies and changing cash flows, sometimes internal funds will not be enough to cover the capital expenditures. So in this case, if I have more money than my expenditures, then I'm going to pay off my debt. But if I don't have enough money, then if my cash balance is getting smaller, I will try to create cash. I can sell my marketable securities if I have any. And if external finance is required, then I'm going to use debt, convertible bonds, then equity. So this is what pecking order theory says. So there's no target debt-to-equity ratio. Profitable firms use less debt. And the third one, I don't remember. Do you remember the third one? There was a third item there. I don't remember. OK. So this is what pecking order theory says. Last theory I'm going to talk about is the market timing theory. Only one slide. This is Baker and Wergler. They basically said managers will issue equity when stock is overpriced, and they're going to issue debt when stock is underpriced, as you said. And basically, all the capital structure the company is using right now is the cumulative market timing efforts. And the evidence for market timing is kind of mixed in the literature. And I'm going to talk about them in like 5 minutes anyway. OK. As like a sum up, I want to mention signaling one more time. So basically, investors view that as a signal of firm value. If firms expect low profits, they will use more debt. If firms expect high profits, they will use higher debt. So basically, if a manager is trying to fool investors using debt, the manager will be in trouble because it's going to be impossible to fool debt holders all the time. OK, any questions about any of the theories? Yes?
It's not about any theory, but what's a convertible bond? I know that it's like something to do with it can be converted from debt to equity. And
exactly, that's it. Generally, debt to equity. So it's basically there's a clause on the agreements of debt. So when debt holders see it necessary, they can convert their debt for equity. It's going to be if it's a $500,000 debt, they can convert it into $500,000 worth of equity. So they become equity holders. And they can do it when they see agency cost very high. So if they want to be an equity holder, they're going to use convertible bond. OK. So now let's look at some real-life evidence. As I said, I'm going to put slides just after the class. And sorry for the inconvenience. OK. What do we see in real life? And I'm going to actually show you lots of mixed evidence. OK, I'm not going to show you, oh, pecking order works or market timing works. No, there will be mixed evidence. In academia, there are people writing about capital structure theories all the time. This is not a solved mystery. And I will just give you some different ways of thinking or looking at the data. OK? So we talk about three theories: trade-off theory, pecking order theory, and market timing theory. So in this class, today we will try to see whether companies choose target debt ratios, or when they decide about financing, how do they make the decisions. And most of the slides I'm going to show you will be from this survey paper by Graham and Harvey. I will put it on Moodle, and it would be really good for you if you can read it. These guys are from Duke, basically, and they talk to almost 400 CEOs and CFOs, and they ask questions about investment decisions and capital structure decisions. And these are very explanatory because this is like the most real evidence on capital structure. What do CEOs consider? Of course, sometimes they're going to hide their real incentive, but we're going to take their answers as true, let's say. Okay, so first let me show you a couple of random tables. Okay, one is here. We have different leverage ratios of different companies. We have Altria Group. It has 50% debt to equity ratio. The industry is 1.12. What industry Altria Group is in? Is there any marketing people here? Because I know some of you want to work for them. Altria Group. You know Philip Morris? Okay, they own Philip Morris. So it's like a tobacco company, right? Okay, so that's one thing. We have GE. Its debt to equity ratio is 4, where industry average is 2.6. GE is a conglomerate firm. Lots of different businesses. So they are more diversified. They can take on more risk. So it's not surprising. We have Johnson & Johnson. It has this much debt compared to the industry, half of what the industry is using. Microsoft doesn't have any debt whatsoever. Its industry has very low debt. This is probably a technology company, right? It's considered as technology. It has low debt to equity ratios. We have airline industry where debt ratios are high. Procter & Gamble, Coca-Cola, Nike, ExxonMobil. Is this a cell phone company, you think? Huh?
Gas.
And you woke up. Yes. No. No. You said what?
I said gas.
Exactly. I actually thought, like when I first prepared this, first I thought it was a mobile company. No, it's a. But I was like very young and very inexperienced. Let's say. Okay. ExxonMobil is a gas company, and it has around like 7% debt. Why am I showing you this? As you can see, different industries have different leverage ratios, but there are still some idiosyncratic differences. Idiosyncratic means firm-specific differences. So hopefully we're going to talk why firms have different leverage ratios today. Okay, if you look at debt to asset ratio for US firms, the blue one is S&P 500 firms from 1975 to 2008. As you can see, the debt ratio was around 35% to like now it's around 35–40%. If you focus on non-financial corporations, it is more or less the same. And as expected, in bad times, there's less debt being used. Okay, any questions? Okay, so debt to asset ratio is around 30–40% for US companies. If you want to see the international evidence, Canada doesn't use that, use 45% debt ratio, but in Japan we have 70% of debt. So even different different countries might have different capital structures.
Assets of countries.
This is not, sorry, this is not country. Thank you so much for clarification. This is for companies' assets. Like in general, when you look at corporations, what do you see? For in Japan, Japanese companies have 70% debt on average. Okay, thank you for clarification. Okay. A number of firms don't have any debt whatsoever. Agarwal and Nagarajan, they wrote a paper in 1990, and in that time they showed over 100 corporations listed in big US exchange don't have any long-term debt. And they have those companies have lots of cash, and these are the companies where we see lots of family involvement or CEOs having lots of equity ownership. So the idea is once the owner is kind of the equity holder as well, they don't prefer to use debt. Why? They don't want to deal with agency conflicts, of course. So just this is something small. Not all companies should have debt. But we said that is good because it gives more monitoring. It might decrease agency costs as well. OK, now moving more to the evidence. Can you see this clearly at all? OK, I'm gonna read it. So around 20%, OK, this is from Graham and Harvey survey. They talked to 900 CFOs, published in JFE in 2001. And they ask whether their companies have target debt-to-equity ratios. And 20% of companies said no. 20% of companies said no, we don't have any targets, target ratio, or target range. And those companies are probably following which theory? Which theory didn't talk about targets, capital structure? Thank you. Yes, they're maybe using pecking. Maybe they're using pecking order. Maybe market timing. Market timing doesn't talk about target ratios. So, but this is definitely against M&M. Okay, 10% of them says we have very strict target debt-to-equity ratios, and these are probably using some kind of M&M theory, trade-off theory. But here, most of the people, most of the CFOs said we have somewhat tight target and range. And actually, this answer was more common in large firms, regulated firms, and investment-grade firms. So basically, these companies are more relaxed about target debt-to-equity ratios. And 37 of the CFOs said we have flexible targets, so we change it all the time. OK, so this is what we see in general. It doesn't say much about which theory works. But let's move to other questions that are asked. And these are more specific questions about capital structure. So the first question they ask is, they ask factors affecting their debt policy. So let's look at the answers very quickly. So most of them says financial flexibility. Do you remember which one was talking about financial flexibility? It was actually the third item I forgot about when I was reviewing the theory. Financial flexibility is important for pecking order. Yes, he's right. John, thank you. OK, pecking order theory says financial flexibility is really important. We have credit rating, earnings volatility, lack of internal funds. Oh, pecking order. Interest rates, tax savings. Which theory? M&M. Transaction cost, equity valuation, maybe like signaling, and pecking order, maybe. Peer firm debt to equity level, competitors in the industry. Bankruptcy costs, which one? M&M. Customer supplier relationships. OK, let's focus on them. So if M&M theory is the most common one, we should see tax savings and bankruptcy costs to be really, really important. Here, 45% of the CEOs said tax savings is important for us. And actually, they ask more questions about it, but I didn't put everything here. But generally, large regulated and dividend-paying firms said tax savings are important for us. It's not surprising because large firms are paying, they have more taxable income. So a change in the tax payment to the government affects their decision more. So it's not very surprising. Another thing was bankruptcy costs. Only 20% of firms said we care about bankruptcy costs, which seemed like it's not supporting the M&M, but we have credit rating here, and I don't know, almost 60% of firms said credit rating is really important for us. What is credit rating related to? And it's related to debt ratio, and it tells you about how close a company to the bankruptcy. So maybe they don't say bankruptcy costs are important for them, but they say credit rating is important. So indirectly, actually, it supports M&M. Okay. Earnings volatility. Okay, earnings volatility is about what? No, which theory? It might be about M&M. Why? Because if earnings are very volatile, then bankruptcy cost might be really high. It might be about pecking order as well, right? If your earnings are very volatile, then your internal funds might be enough or not enough in some periods. So it might be related to both. We talk about financial flexibility. We said pecking order theory puts a lot of attention on financial flexibility. And customer-supplier relationship is also very important in leverage. Actually, I have a paper on this as well. If a firm is producing lots of unique products, for instance, they are using less debt because they are more customer-specific. They're doing more customer-specific production. So when they're in trouble, the bankruptcy cost will be very high for them. And 20% of the CEO said we also pay attention to customer and supplier relationship. So as you can see, there is no direct evidence on any of the theories. And this is what I'm going to do in every slide. Okay? We're going to talk about all of them together. Okay. So they ask another question about factors affecting their debt policy. So here, the most common answer was, we issue debt when interest rates are particularly low. Okay. What is it related to? Which theory? Market timing, right? If the interest rates are very low, then they use debt. Definitely market timing. We issue debt when our recent profits are not sufficient to fund our activities. 47% of CFOs said that. So it supports which theory? Pecking order. Perfect. We use debt when our equity is undervalued by the markets. Pecking order, right? And pecking order, this is exactly what I think the slide was saying. So when the equity is undervalued, they use debt because issuance of equity will decrease the stock price even more. Changes in price of our common stock. I don't think we have anything related to. We didn't talk about it. But basically, they focus on it when the stock price changes. It might be kind of related to pecking order. So if stock price increased a lot, then maybe they're overvalued and they might issue equity. It might be related to pecking order. We delay issuing debt because of transaction costs and fees. This is something also we didn't talk much about it, but I'm going to talk a little bit about adjustment costs, which is not related to it. But anyway, they asked this because Fisher et al. Argue that a firm rebalances its debt when its debt ratio crosses a hurdle. So when they believe that transaction costs will be a problem, then they might be changing their capital structure decisions. And I think this was the last thing I will focus on. Issuing debt gives investors a better impression of our firm's prospects than issuing common stock, which was about pecking order and signaling, actually, yes. And it says we issue debt when we have accumulated substantial profits, which can be kind of related to pecking order as well. So we use maybe internal funds first, and after that we use debt. Okay, and pecking order said profitable firms will have more or less debt? Yes. Less debt. So is this against or in line with pecking order?
It's in line because it's low,
huh?
importance. It has a low importance, so it should be in line.
Exactly. So normally this sentence alone, it is it should be against pecking order, but only 1% of CEOs, like three people said it's important. So it is in line with pecking order. Okay. Okay, we talk about those. Okay. Just a small question to wake you up a little bit. Which one use more debts? Firms with lots of tangible assets, firms with lots of R&D? Tangible. Tangible, okay, perfect. Very good, we move on. Okay, another thing to keep in mind, capital structure differs among industries, and we talk about bankruptcy costs and stuff, and this is just an evidence of what we just talked about. So there are industries with high leverage like air transport, television broadcasting, hotels and lodging, natural gas distribution, building construction. What's the common thing in all of those 5 industries? Lots of tangible assets. Perfect. The other one is low leverage group of industries, educational services, drugs, biological products, electronics, and computers. These have intangible assets, high risk, lots of R&D expenditure. Exactly. Okay, now let's talk a little bit of factors that will affect the equity policy. The first one is earnings per share dilution. And the answer was the most common one. 70% of CFOs said we consider earnings per share dilution when we think about issuing equity. What is earnings per share dilution?
The more shares you issue, the lower the earnings per share.
Thank you so much. Exactly. So if you issue lots of shares, what is earnings per share? It is income over average numbers of shares outstanding, right? So if you have lots of shares, your earnings per share will decrease. So apparently this is a huge problem for CFOs. Actually, like the textbook, if you look at Briley and Myers, it says it shouldn't be a problem because equity is riskier and actually investors will be aware of this and they're not going to react to decrease earnings per share because of equity issuance. But 70% of CFOs said this is the most important thing. Then we have current equity valuation, which is related to what? CFOs care about their equity valuation when they issue equity, which is related to which theory? Pecking order, right? Okay, maintain target debt to equity ratio is also given, like 50% of CFOs said that, which is in line with M&M, right? They have a target debt to equity ratio. But then they ask it in a different way. Do you remember the graph with pies? Only 10% of it, 10% of the CFOs said, yeah, we have strict target debt to equity ratio. When you asked the same question a different way, 50% of it said we have a target debt to equity ratio. Sufficient internal funds is important for 30% of CFOs. So it is maybe in line, maybe against pecking order, because for pecking order, it should be internal funds, debt, and equity. And maybe for equity offering, internal funds shouldn't be that important, but it still is. Okay. So you look at current equity valuation, and we said it is in line with, it's in line with what? A kind of pecking order, but it's also related to what? Market timing as well, right? So if you think equity is cheaper, then you might be issuing equity. So there's a window of opportunity here. And okay. So that's interesting because we said equity is the cheapest form of, we said that is the cheapest form of equity, but 15% of CFOs said no, equity is cheaper for us. And it might be because of, about the structure of companies. So for what kind of companies you think equity will be cheaper? Small companies or large companies? Huh?
Large.
I think for large companies, right? So there's like an minimum cost of IPOs anyway, and its cost is very high for small firms. So maybe large companies said equity is cheaper for us. Okay. So when we look at the papers, academic papers, this is the evidence on pecking order. Now, there are lots of words, just focus on me. So the first one, it was done at the end of 1990s by Shams, Sundar, and Myers. And they look, I'm not going to go into details of those papers, but basically they said our evidence supports pecking order model. And the way they're doing it, they looked at whether companies have target debt to equity ratio. And they say most companies don't have targets, so it means pecking order theory is the ruling one. And they reject trade-off theory, Modiglu and Miller. Then Chirinko and Singha wrote another paper, and basically they said those tests they used, Shyam and Myers, they were really bad, and it was actually biased towards finding favorable results for pecking order. So it was a statistical thing. Again, I'm not going to go into detail, but they just showed the previous paper was kind of garbage. Then Frank and Goyle wrote a paper, and they rejected pecking order theory by showing that firms issue a lot of equity at wrong times. So normally, if pecking order theory is correct, equity should only be issued when there's not enough debt. And they find that net equity issues track financial deficit more closely than net debt issues. Again, if there's a financial deficit, that should be used, not equity, but they show just the opposite. And they also show that riskier firms, high market-to-book firms, like growth firms, they have lower leverage. So basically, when you look at the data, we couldn't say pecking order works. And then there were other papers which look at trade-off theory. So the difficult thing about testing all of those theories is that the target capital structure, target debt to equity ratio is unobservable. You don't see it in the financial statements. So you're just guessing whether there's an optimal capital structure by looking at the data. So Leary and Roberts, they wrote a paper, and they actually used adjustment costs. Normally, in all the Modigliani-Miller tests, we ignore the adjustment cost and transaction cost and everything. And they find evidence in favor of target capital structures. And Flannery and Rangan wrote a paper in 2006. They also use partial adjustment cost, and they also find significant evidence testing the trade-off in favor of the trade-off theory. Funny thing is, some people used random generated data, like you open Excel and you randomly generate the data. And using those techniques, they also find what those papers found, which means what you do has nothing to do with the data, the real data you're using. I'm replicating your results using randomly generated data. So do we have any evidence here? We don't have any evidence here either. So still mixed evidence on everything. Okay, let's just stop here, and then we're going to talk about additional factors.